I think we should get started.
Yeah.
I would categorize, we have kind of an intimate crowd tonight. So I would be tempted literally just to throw it out for Q&A from the beginning, but I'll kind of get started and then hopefully we'll get some discussion going, and maybe I could just veer right off what I was going to talk to. Would be great, actually. If that's all right with all of you. Our team is here, Michelle Blood, Ginger Belker, David Wild, and myself, Russ Piazza. I think it's kind of cool to have it in the business building. I graduated from here. We appreciate the fact that they enabled us to use this room tonight. Dr. Guy Chetta, the dean of the business school, I actually had him as a statistics professor back in college. So and I'd like to thank the technical gentleman, Terry Carter, for coming tonight too. Thanks. So the performance. So as we usually do is start out with what happened last year in the first quarter of this year. And so as most of us know, the S&P has been going up fairly rapidly during these periods. So in 2012, the index was up 16. The first quarter in 2013 was up 10.61%. The Aegis Value Fund for 2012 was up 24.77 and 16.74 in the first quarter of 2013. Fairholme 35 and 8. This is a new fund that David has been working on. So if you have any questions on why we've added Goodhaven, we've had a couple of funds close recently. Fairholme Fund is completely closed to new investors, and Sequoia is partially closed to new investors. And so we've got Longleaf at 16 for the year, 11 for the first quarter. Sequoia at 15 for the year, 10 for the first quarter. And Tarkio is our fund. And was up 21.17 last year and only up 5.95 for the first quarter of this year. And then the Front Street equity accounts are going to, the idea is over time they'll track pretty closely to Tarkio. Getting Tarkio put together has been a little bit more erratic, but was a little less probably for most accounts last year, and a bit greater than that for the first quarter of this year. Any questions on the performance? People that have mutual fund accounts have a mixture of the different funds, some in varying percentages. So, we send out quarterly statements, and those quarterly statements will have your actual performance on them. And so it'll be some blend of what's up here depending on what your percentage mix is. Yeah, Bill?
What can you say about what's happened since the end of the first quarter?
Up. It's continued to go up, actually. And we'll talk about this later, but maybe but what happens in rising markets is you get what's called rotation. And so you get money that moves kind of from category to category, group to group. And if you watch these funds, the performance is fairly erratic quarter to quarter. I mean, one fund will outperform for a quarter, and another one will outperform the next quarter and underperform the next quarter. And it's just a matter in the short term, funds move from category to category. And if you happen to be in the category with the cash flow moving into that direction, then the fund outperforms for a particular quarter. But looking at quarterly performance in a rising market too closely is not a good thing. And you have to look at it more on a yearly basis at least. Maybe go to the chart. Here it is again. We've been showing this chart since 2009. The purpose of the chart up to this point in time was to try to convey to people that why it's probably a good idea to stay invested when literally everybody else was getting out. We think that battle is kind of somewhat over. So what I'm trying to do is look forward and figure out what are the challenges going to be kind of to people's emotional psyche. You know, what's the market going to try to do to people, or the media to try to get them to, you know, kind of look beyond rational thought to make emotional decisions. And so where I'm heading going forward is we've made the case before that we think that 2009 was similar to 1974. And from the bottom in 74 to the top in 2000, the S&P, the index, grew 14.5% a year for 25 years. And we think there could be something quite similar, you know, that is starting from the bottom in 2009. And so we're, you know, if we make that analogy, where we would be today would be, you know, somewhere smack dab in the 1980s. And I've had the I don't know if it's a good fortune, but after you've been around a while, I actually lived through that experience. So what I'm going to try to do actually is to convey to you some of the things that happened during that period that got people off track, that got them to get focused away from what they should have been doing and what that environment was like. So the biggest issue was, if you look, during the 1980s, really it was an excellent time to be invested. However, it was quite bumpy. And we feel quite strongly that the environment will continue to be quite bumpy for us now going forward also. And we think the reason for that is that you know, people get quite scarred during these periods. It was 13 years going into 74 and also 13 years where the market went nowhere going into 2009. And so, you know, people are scarred by that experience. And so they, you know, things start to go up, and so they sort of gingerly kind of tippy-toe back in, and then anything that happens, they get scared back out again. And so we think that going forward, we think the returns could be similarly handsome to what we've seen since '09, but they will continue to be quite bumpy. And we haven't seen, it's been maybe 8 or 9 or 10 months since we've had a good correction. But they haven't gone away, and they will be back, is our strong opinion. And so, because of this during the 1980s, my perception is that what occurred during that period of time was that investors got this perception, this idea that somehow or another they could get the same kind of returns that they could otherwise and avoid the discomfort of down markets by being able to get in and out of all these, out on the top and in back on the bottom of the bumps. And we think that that's an absolute formula for disaster. And it was very prevalent in the 1980s. And the reason for this, in our opinion, is because it draws you away from what you can know, which in our case is the quality of the company and the valuation of the stock. Can you go back? I mean, yeah. The the quality of the company and the valuation of the stock. In our opinion, that's it. Those are the two variables that you can make good, intelligent decisions on, and the more research you do, the more you're going to know these two variables. When you start trying to predict short-term moves in the stock market, you start to focus on things you can never know. And that is what is going to cause the stock market to fluctuate in the short term. And so what it does is it takes you away from what you know, and it puts you right in the middle of what you cannot know. And eventually that catches up and turns into a disaster, in our opinion. Yeah,
Where do you place the cutoff between long-term and short-term? Obviously, a quarter is short-term. What about a year? What about 2 years?
Yeah. So in evaluating a company, I think you should do it 5 to 10 years, actually. And we think that in managing a company, it should certainly be 5 to 10 years or more. So as we've talked, we've kind of enjoyed some good returns since 2009. And so we think this, again, this tailwind will be with us for, if this, we can go back to the chart. If this is any indication, if the similarities are the same, we should have this tailwind for some time to come. But again, we think that the ride is going to be quite bumpy from time and again. And we think that fact that people get scared out easily and that there's fear in the market, we think that's good. We think actually when people are not fearful, when people are fearless, when the majority of investors are fearless, that's the end, the beginning of the end of this long cycle. And we think it's going to be a long time before people get over this experience before they become literally fearless. And that's when bubbles get created, is when fear completely goes away. So we like the fact that people are going to continue to be fearful, and when bad news comes out, we think they're going to head for the exits fairly rapidly.
So why is that to our advantage?
I don't know if it's to your advantage, but what is to your advantage is to recognize it and deal with it rather than become emotionally distraught over what is going to be what we think is a natural occurrence. Yeah, I'm not saying what's good or bad, I'm just saying what the environment should be like, in our opinion. The good part is that, if we're right, there could be, some, the kind of returns that we've had might be something that would be in our future for some time. And the trade-off would be you're just going to have to accept the fact that periodically we're going to hit speed bumps that are not going to be very pleasant. That's all.
I realize you don't have a crystal ball, but the market reaction is an indication possibly of some future problems. When the Fed drops quantitative easing, the money supply is way out of focus right now. Do you think that's going to have an impact on the market as a whole and on the select stocks, the companies that you're backing?
Yeah, so with backing off of the accelerator is what you're talking about. And the key ingredient is going to be that interest rates will rise.
Rates will go up.
Yeah. And the rates are so far out of whack, and the Fed has done a fairly heroic job of keeping rates as low as they are for as long as they are, but that it absolutely cannot continue. And so part of this whole cycle, we think, is going to be that rates will go up and cause bond prices to decline, and we think that'll actually be, when the bond prices decline, it'll help provide stability for stocks when the declines do hit. when the corrections hit on the stock market, we think the money coming out of the fixed income markets will provide stability so that those declines don't get momentum beyond a fairly short-term decline.
We hope.
Yeah, well, actually, let's go to that. Can we go to that slide, the pie chart? This is good. We can skip around. So this is sort of, Tom, this is going to kind of, I think this is going to get sort of to the root of your question. So we think that to be an investment versus a speculation, we think you have to be able to value whatever it is that you're looking to buy. And if you can't value it, then it's a pure speculation and not an investment. So we think to value something, it has to produce money, has to produce cash. The entity has to produce some kind of income. You have to be able to look out in the future and say, well, it's going to, I think that this thing will produce so much cash flow over some period of time, and then theoretically you discount that back to today's value. And that gives you a reasonable idea of what you might want to pay for that. Without that, we think it becomes a pure speculation. And so we think that there's a lot of pie charts are really popular these days. And so we got our own pie chart. And so we think that really and truly, there's all this talk about asset allocation. We think there's only 3 asset classes. Because there's only 3 entities that produce cash. And they would be fixed income securities, real estate, and businesses. And buying a common stock is owning a piece of a business. And there are derivatives of those 3 large buckets. But we think there's really only 3 asset classes. Now, until recently, we talked before about stocks, bottoming out possibly, and how unpopular that they got, both in '74 and 2009. Stocks became so unpopular that the financial services industry decided to try to invent, in our opinion, a whole bunch of new pieces to the pie, just so that they could reduce the amount of equity exposure in one's portfolio. Did anything possible to make that slice of the pie smaller and smaller. And so in our opinion, we think that stocks became dramatically under-owned, that a small percentage of the population finally owned stocks in 2009 after getting beat up for 13 years. And so, some of the pie, the pieces of the pie that were invented, in our opinion, sort of invented, were hedge funds. People were buying funds of hedge funds. People were buying commodity funds. People were being sold precious metal funds. And after a while, they just start, in our opinion, they just start making this stuff up. And we had a few new accounts come in over the last couple of years. And the stuff that I saw coming in was kind of crazy. One fund was an alternative investment fund. What the heck is that? And so literally, I think, the financial services industry is real good about making stuff up to create whatever it is that they need to sell. And so back to the pie chart. periodically, one of these three pieces to the pie gets overvalued. Gets sort of a bubble gets created. And so we think what happens is that one of them, from time to time, one of them just gets stuffed with cash. They just get overstuffed with money. And that, it's important, we don't think it's that hard actually to recognize that. But it's important to recognize when one of these three pieces of the pie gets out of whack. And as we know, in 1996, the stock market started to get out of whack and finally boiled over in 2000. 2007, the real estate piece of the pie got way out of whack. And we think, as we speak, the fixed income piece of the pie is totally out of whack, in answer to your question. And so what happens is when one of these things gets so stuffed full of cash, and then the bubble finally gets pricked, the cash moves to the other two. So we think what's important is to recognize which of the three is, out of kilter. And it generally, for us, means the other two are probably pretty safe. I mean, there's normal fluctuations that go on, and real estate will have its normal sort of problems as you go. But we think stocks and real estate will be fed by the fixed income bubble that breaks, and we think it'll be fed for quite some time to come, when that money starts moving out of that asset class. There's a question coming.
Well, is this what happened today in the market? To me, it's goofy.
Today is one day, one quarter, 1 month means absolutely nothing. I mean, like I said, if you start focusing on why the market, or trying to project why the market may move in a particular day or week or month, you're just going to get, that's how people get into big trouble.
I'm looking more at the money supply that seems to be overvalued.
Yeah, everything to us points that this is out of whack. That's clearly out of whack. Yeah, Jack?
What all things are pointing to that? I mean, I don't know why anybody would put money in fixed income right now, because it's not returning anything, but...
It's overvalued.
Yeah.
People are
Is that
paying
related?
way too much to buy a 10-year bond.
There's still money going into them.
It's starting to, it's starting to reverse itself.
Isn't that money that came out of the stock market in the last 5 years?
Yeah, it was fed. Yeah, it was certainly fed by money coming out of real estate and out of the stock market over the last 13 years, actually, between the two of them. One first and then the other one.
So the Federal Reserve, these bonds that they've been buying for some time, several $1 million a month, is that helping stuff that?
Yes. Yes, absolutely.
Under-
If you read carefully or you listen to Ben Bernanke, he's just like petrified, really, and he should be. I mean, he's done everything right, in our opinion, but how he gets out of what he created without causing a lot of ruckus is going to be, you could just see it in his eyes. It's going to be difficult, and he knows that he can't do it without creating, some havoc at some point in time. But he also knew that he had to do it because the havoc we were in before, needed strong measures to get us through it. And now, how do you reverse that without, creating another sort of panic on the other side? And we think it will be somewhat of a panic, but the problem is going to be here. Now, the other issue is going to be the stock market always reacts negatively in a very short term to anything that happens that's different. So, yeah, when the rates start to go up dramatically and quickly, the odds are that's going to be a good reason for the market to take one of these corrections that we're talking about. But we think that there's going to be capital underneath it to support it, that it's not going to take on a momentum of its own. It'll get shored up in some reasonable period of time. And we think if you're prepared for that, the purpose of this is to prepare you for that so that you'll be okay with it. And God forbid that you might actually throw a little money in when the prices are lower. And if you have that mentality, even if you didn't do it, it's going to help you get through because you're going to have a different mindset. Boy, I got a little cash on the sideline, maybe I should put it in when things go down. And it sort of reverses where everybody else's mindset is going to be, and that would be a really good thing. And it's a luxury if you can put a little money in when it's down, but not a necessity by any way, shape, or form.
How big a factor is competitiveness of American industry in the world?
Yeah.
And do you see a change in that is part of what's coming?
Yeah, I do, actually. You have the Deming video? I'm kidding. But actually, the companies that have come through all this, I think as a whole, American business is better than probably it's been for a long, long time. And I've been traveling again. We just recently went to Gentex and I went to Herman Miller. And, the criteria that we think makes companies great, I think is more prevalent across more companies today than it has been in a long time in this country. And I think we are more competitive. And the executives of the companies that I've talked to are getting that same sense with their suppliers and people that they're doing business with.
Why?
It's going through this whole period. We had the tools. The Japanese had the tools.
And they lost it.
They actually didn't lose it. There was other factors that caused the Japanese economy but the factor that the way they ran their companies was still fabulous, and the tool and the management tools they used were incredible. And we in this country started to figure it out and started to bring these management techniques over, and those that were able to survive, the Great Recession most successfully are companies that adhere to these principles.
I'm sorry if I missed this, but how much cash is the fund holding now?
The cash is just about $13 million.
As a percentage, what is that? As a percentage of
Oh, how much cash in the fund?
Yes.
Very little. It's about, Michelle? $280,000, I think, is what it is. $285,000.
13 million.
Yeah. Yeah, Chris.
Of course, you're talking about people are going to flee these fixed income vehicles. So if you're retired, what does that do to your percentage of your portfolio in fixed income? Should you lessen that? Should you keep it the same?
Yeah, our opinion, and it's contrary to what the financial services industry would want somebody who worked in that industry, for a company would want to tell you. But we think if an asset class is overvalued, then it shouldn't be owned, period. And unfortunately, the markets don't know nor care what position your life is in, how old you are, when you started working, when you stopped working. Markets don't care. They're going to do what they're going to do. And interest rates are zero, and they can't stay that way forever. And when they go up, the values of those securities are going to go down. And it's a difficult situation for somebody that normally would buy fixed income securities. But I can't change a difficult situation.
So you have a
And the way we've handled it is, we haven't bought a bond in 3 years. But we just if you look at our website, It said that we stopped accepting fixed income accounts about 3 years ago.
Do you believe in diversification?
Well, there's a couple of answers to that question. Warren Buffett says that diversification is protection against ignorance. If you're not ignorant, you don't need it. What's really important is to know what you're doing.
That helps.
And most of the time, knowing what you're doing is probably a more concentrated approach. Now, that said, you have to have, I mean, you look at our accounts, there's 25, 26 stocks in there. You know, that's, you know, the idea, we don't own 5, we own 25. So there's some diversification there. We own several different funds to get some diversification.
What's your biggest position as a percentage of the fund?
As a percentage of the fund, it's level 3.
And that's approximately how, what?
It's a little less than 8% of the fund.
You answered.
That gets to one of the questions I thought, you're gonna ask what you saw in the future for level 3.
Cool. Yeah, we can do that. Actually, let me just look through this quick to make sure I'm not missing something, and then I'll go right to it. You know, staying with this fixed income before I forget,
Yeah, go
the rates peaked in 1982. So for any investor that's younger than 56 years old, they don't know, they've never seen interest rate risk.
There was a time when things went crazy. They were going up like crazy. That was a disaster of its own.
Unless you were buying bonds.
All right, so let's talk about the telecommunications industry. I happen to be ready for that question. So we have 3 companies in this space. We have level 3, Oclaro, and most of you are probably disappointed with those 2 names, and more recently, JDS Uniphase. Okay. And so the story on the story on the telecommunications industry, as we see it, is that I was introduced to fiber optic technology in 1998 with a company called Raycap. And it's been kind of a journey ever since. But at that point in time, all these incredible things were projected to happen once fiber became end-to-end in the United States or in anywhere. That you could send letters and look at video. I mean, everything that we see today was a dream back then. And it's all occurred. And the way this is all developed, and the reason is because of glass, fiber optic technology. And by the way, the cloud, that sounds quite wireless, doesn't it? The cloud is hardwired with glass. And I mean, there isn't enough bandwidth that goes through wireless communications to handle the kind of stuff that we're doing now. And so what happens in wireless is the faster you can get that off the tower onto the fiber network, the more robust the system is and the more bandwidth you're going to get with your wireless device. So all this wireless stuff is literally hardwired and will continue to be so. So what happened to the industry was early on, in the promise of all this, these things that I had heard about created a speculative boom or bubble in cash available to build out the fiber optic networks between 1996 and 2000. And massive amounts of money were available to do this and dig up the streets and to get the right-of-ways, and most of the network was installed at that point in time. there was so much money available that it created excesses. There was more capacity available than there was traffic to be run over the network. So pure economics say that the price that people could pay, to deliver information over the network, dropped dramatically. And as fast as we could find that slide someplace. As fast as the network traffic was growing, the prices were dropping even faster. And that doesn't really make for a great economic model. And so these companies ran on very difficult times, and a collapse occurred throughout the entire industry. And we're talking about stocks that, level 3, if you take all the reverse splits and everything out, is probably is the equivalent of several $100s a share. Actually, more than that. It would be probably $900 or $1,000 a share, and it's 20 today. Okay. And so, what's that?
Montana Power.
Montana Power. In fact, why do we own level 3? Level 3 owns the network, similar to what Touch America did and many other companies. The difference is that level 3 is the only fiber optic cable network company that built a network end to end that did not go bankrupt. The rest of them, every other one of them went bankrupt. Now, in retrospect, if we would have bought one of these companies that went bankrupt and waited until they come out of bankruptcy, and then they would have had no debt, we would have been further ahead of the game at this point in time. Because those stocks have done better than level 3, because level 3 has had this debt burden that they've been carrying around with them.
Is level 3 in danger of antitrust or anti-monopoly action?
That's a good question. They are a dominant network across the globe.
And
Their network right now is so robust. They merged with Global Crossing, so they took the most robust network in the United States and merged it with the most robust network across the globe. And so they do not need to acquire other companies. And so right now, all they need to do is to make sure that they get the most out of what they have. If they did go out and buy a bunch of other companies like they have done over the years, that might be an issue. But they're not, that's not part of their strategic game plan.
So not at this time.
Correct. And so it was a good thing that the prices collapsed for the network providers. Because that's why we have all this stuff. We wouldn't have all this stuff if the prices hadn't plummeted. That's why the uses proliferated. And the ones with the compounding. Yeah. So network traffic has been growing between 80 and 100% a year since 1997. If you network traffic has been growing at 80 to 100% a year, compounded since about 1997. And so, if you look at the numbers, this is 80% of 1. That's what that turns into, and at 10%, that's what that number turns into. It's monstrous. Compounding at those rates becomes a monstrous number. And so our theory has been that as long as we continue to see network traffic explode, as it has been year after year, and by the way, video, it just knocks it off the charts. The amount of bandwidth it takes to run video over the network is thousands of times larger than data or voice or anything. And so that's been a whole nother explosion on top of that. And there are other explosions coming beyond that. When computers, like the machine to machine, when computers just start talking to each other without any interface of people in between to get things done, the explosion is still occurring. And so our theory is, as long as the data is growing on the network at that pace, the economics have to change. And at some point in time, will change dramatically. The reason is because it's a fixed asset. The money has already been spent. The billions of dollars to build a network, were offered up at in a speculative period, but that money will never be available again. And they're never going to be able to dig up the streets again like they did. And so it's a toll road. We just have to wait until the traffic gets to the point where the prices start to not only stabilize, but maybe even inch up, and then the data keeps growing, the amount of network traffic keeps growing, and suddenly the model turns dramatically profitable. And we've been right on the edge of that now for a few years. But as long as the data keeps growing at the pace that it is, we're committed. I've been through these kind of things before. This is where you talked before about, what's your time horizon. The payoff should be monstrous for this kind of a situation. But it's taken the patience of Job.
Does fiber optic cable deteriorate with age?
No. No.
Just the owners.
Yeah, there's no other, the technology, and that's been part of the problem. The technology is so efficient. There's no way that there's going to be some other kind of technology, certainly in our lifetime. And people talk about this, they go in the history of man, that you couldn't foresee. That's a stretch, but this technology is super efficient, unbelievably efficient. Yeah, Jeff.
Say this. Is there a projection of when the demand will reach the current supply of bandwidth? When the demand for bandwidth meets the current supply of bandwidth?
Yeah, we think we're there. We think we're going right through that curve as we speak. There's a lot of dynamics. The AT&T and Verizon, and two of the companies are equipment companies. And that business has been very cyclical, they make the equipment that hook onto the network. And our opinion is that at some point in time we won't own the network, the equipment companies, and we'll just own the network. Because it will hopefully catch it on an upcycle at some point and either move on or wait for a down cycle and maybe get back in later. But the network company, there's no way that is ever going to get replaced by anybody. And so what's been happening with the equipment is, initially the money has been in the last piece with the wireless. That's where AT&T and Verizon have been spending their capital dollars. But at some point in time, you can't starve the fiber optic, the backbone, indefinitely. And the longer you wait, again, that they've been forced to put all this money into the last little piece, which is the wireless piece. Because you get so mad when your cell phone doesn't, work properly. So they've just been on this treadmill to keep spending more and more money just to keep maintain, service in that last little piece. And so you can postpone putting the money into the backbone, which is the middle. But you can only postpone it so far. And that's why this business becomes very cyclical. because they'll run it hotter and hotter and hotter and hotter, and then, because they'll only spend it when they need to because they have to spend it on the wireless side. But they finally get to a point, and then they all have to spend, and they come in tidal waves. And with the last tidal wave we saw was from 1999 till about the end of 2010. And our problem child, Eau Claro, went 10 times during that period. It was a 10-bagger. Now, I didn't sell it. So, that's my huge mistake. And there's some circumstances why we didn't, and we're just stupid, but we didn't. But that doesn't mean that there's not going to be another cycle. And there was so much spending during the first part of that equipment cycle that they overbought to make sure they had enough inventory because they couldn't get parts. And so there was an inventory correction initially. So the sales fell off of a cliff. And then things started to get caught up, and the spending started to come back. And then there was a flood in Thailand that wiped out 60% of the manufacturing for the industry. All the companies used the same 2 or 3 contract suppliers that had manufacturing capacity in Thailand, and there's pictures there where the water was literally up to the ceiling. I mean, the manufacturing was wiped out. So these are big projects that these people implement, that the networks implement to upgrade their networks. And so you're not going to go through a big upgrade cycle if you can't get parts. So it all got pushed back again. And then, we got a timeline here, someplace. I think, yeah, so the industry wasn't really operational until the third quarter of 2012. And then, by that time, the demand got so great. This equipment comes in speeds. You can transmit the information in different speeds. So there's 10 gig. It started out like 2 gig, and then it went to 10 gig, and then the next generation was going to be 40 gig. And so somewhere, at the end of 2012, it became evident that, this leap from 10 gig to 40 gig was probably not going to be sufficient. Things had gone on for so long that they had to make the next leap, which is to 100 gig. However, when you make that next leap to the next speed, you have to redesign your architecture again. You have to re-qualify all your suppliers. And so it got pushed out again. And earlier this year, JDS Uniphase, which is a stock we just bought recently, we owned a little bit of it before, but we really took a serious position in it recently. JDS Uniphase is arguably the technology leader. They also have some test and measurement businesses in this area, which gives them a clearer eye as to what's coming. The customers have to work closer with them than they would with the other suppliers. And at the beginning of the year, they were just literally jumping up and down, screaming that the orders were imminent. And the budgets were publicly released. And they were massive. You can go to the next one. Here's Sienna, who's we own a little bit of Sienna in the fund also. And the equipment companies would be a supplier to Sienna. Sienna designs these architectures for the different speeds, and they're the leader in 100 gig. And, this is the word that they use. You know, they're staggering. What these companies we're seeing were staggering. They just have not pulled the trigger, and we haven't seen the orders come in yet. So what we own the network with a burden of debt that, you know, in our opinion, my opinion is we could have made more money if we would have bought a company that went through bankruptcy, threw in the towel, got all their debt wiped out. I kind of like the idea that we're aligned with the people that decided that their obligations were something that they were going to pay. We think that's going to pay off for both of us. We think that's a good thing. And eventually we're going to get paid for that.
Is there sufficient price elasticity and demand to, you know, when they reach a point where there's not enough supply, how much elasticity is there in price? How much can the price be raised and the traffic continue?
Yeah, you don't have to raise the prices because the growth is so extraordinary. You just have to make it level, just so the prices aren't going down anymore, or going down at a slower rate even than the traffic is growing. And the traffic is growing so robustly. You know, like I said, the 2000 and what is that? 2001. This is the traffic today. This is what it was in 2001. It's a rounding error now.
Is the increase in capacity being able to be done so that the efficiency per unit of transmission or whatever, those costs continue to be modest?
Yeah, we think it's a fixed cost business for the most part. It's a fixed cost business. And so when you get up above that fixed cost, it should turn into cash. We've had this conversation at prior meetings. It hasn't happened for our company yet. Primarily because of, you know, they've got a bigger debt burden that they got to cover first, that some of the other companies didn't have. And again, in retrospect, probably would have been better off buying one of the companies that didn't have the debt. But we do, and we like the people, and we like the fact that they were people that honored their obligations. And Walter Scott is the chairman of the board of Level 3. He runs Peter Kiewit Construction. He's a board member on Berkshire Hathaway. As far as in this industry, he's probably about the highest quality people we could find, at least in my opinion. David, do you have anything to add into this?
I don't. What more could be said?
I'm not sure David actually believes me completely on this story, but he's been my harshest critic over this whole thing. So,
How does O'Claro fit into this?
yeah, no, excellent question. So it became obvious, you know, JDS Uniphase came through this whole thing like a Sherman tank. I mean, they've been running right through this thing. Their balance sheet's great. Their technology's great. They have not made a lot of acquisitions. They've internally developed all their own products. They've been on a Deming mission for several years. What we talked about before, this lean manufacturing. They're a Sherman tank. And they also have a couple of other businesses that are related, but not exactly in this area. So they've had some diversification, from this equipment space. So they really have come through this clearly stronger than anybody else. And at the beginning, by the way, I couldn't see who the clear winner was. It's clear to me that JDS Uniphase, we think anyways, is the strongest player of the group. So we own the strongest player, certainly financially and technically. And we also own the weakest player financially, but arguably either the number 1 or 2 player in this thing called 100G. So this leap that they made from 40 to 100 should be very significant for this company that right now financially is fighting a few battles.
So when does all this explosion in price occur?
Yeah. I don't know. We bought a little bit, I mean, that's what we've been buying in here. You know, as long as I know if, we normally don't care about when. We're concerned that if something happens. And that's really the reason why we loaded up on JDS Uniphase. You know, what kind of condition is Oclaro going to be when the turn actually comes? You know, we didn't really have a crystal ball, and so really part of the reason why we took on JDS Uniphase in as strong a position as we did when we did it. But Phil Fisher writes about this, that the highest cost producer will have the biggest run, the stock will have the biggest move from bottom to top when an industry cycle turns. Because the earnings go from a negative number to a hugely positive number, where the low-cost producer is already starting with a fair amount of earnings to get started, but the low-cost producer goes from red to black.
Well, I guess the one thing that is a factor, you say the market doesn't care how old we are, when we're working, or whether we're retired. Obviously, it doesn't. However, if all of this that you're talking about is going to materialize in the year 2030, it probably is not going to benefit me. And so as individuals, depending on our age, when that happens, can be significant.
Yes. So, can I use your own analogies?
Yes.
Really? You don't mind?
Yeah.
Okay, so I remember at least 3 years you had that same comment about Cognex.
Yes. Yes, and they finally performed.
Yes. I didn't know exactly what the answer was then. Again, we did determine if it was going to happen, but I couldn't tell you when. And the great investments are that way. That they, you don't know when they're going to happen, and it also gives you a chance to buy all you want at prices that you want to, and then when it happens, it happens. And we're not hurting. The accounts are not hurting. We're able to drag this anchor around with us. Yeah, Chris.
What are your thoughts on 3D printing?
David?
I looked briefly at a company several years ago called Stratasys, which is one of the reported technology leaders in this space, has a pretty interesting story, and I quickly, at least for me, Russ would probably be better at this, I understood or got today was outside my circle of competence. I keep seeing articles in the Wall Street Journal every week. There's a big article. I can understand the importance of what they're trying to achieve by being able to rapidly print and develop, but we start with those criteria right there, and then sort of have to learn once we find the people about a specific industry, and so that one was not one that I was going to tackle based on the industry, and then try to reverse engineer and find the best people.
My answer to your question would be, this is our criteria, and this is the Deming model. This is the Toyota model. The questions that were asked before about how's U.S. industry doing, they're doing fine. We think, according to this model, we're seeing more positive stuff than I've ever seen before on a broader scale. But this is the criteria we look for companies. And like David said, the scary thing is, and I will make one exception, and that's this sort of disease that I've got with fiber optic technology, that I got introduced to it way too early, that I could see it evolve, and I probably spent too much time with it than I needed to. But beyond that, this is the criteria that we use. It's a management criteria, and it leads us to a bunch of different industries. And particularly, the scariest, the least certainty is in some kind of a new industry. Because there's lots of capital available, it's all pie in the sky, everyone wants to get in, there's speculative money available, and there's hundreds and hundreds of competitors. And then they all have to get weeded out. Cognex is a good example. There were hundreds of competitors when we first bought Cognex. There's probably 2 now. Cerner, there was hundreds of competitors. There are 2 left. Unless you can identify the right principles with the management of the company, you don't want to go chasing after a particular industry, particularly an industry that's many people think are exciting. Because there's high prices built into it, there's a weeding out process that needs to be done, the odds are quite low, and if you go out looking for that stuff, it's the odds of success, plummet, actually.
Not your balloon, but ADC.
Yeah, that was a different, again, that's part of my telecom history, so.
Russ?
Yeah, Jeff.
You mentioned Cerner, and that was one I had a question on. In my portfolio,
Wow, really?
at least, That's,
Somebody wants to know about one that went way up, that's great.
Yeah, well, in my portfolio, that's a 10 bank. And I guess my question is there room for that to continue?
Yeah, so if you noticed, we sliced a pretty good piece off of Cerner maybe a year and a half ago.
Yeah, you sold a.
And so Cerner makes, do we need a break at all? Are we okay? Everybody okay? So what Cerner makes is software, IT for hospitals. So that, doctors can get your records and put them in a database, and you can get all this information and store them in a database, and eventually you can take that database and use all kinds of creative things with it. But first thing you have to do is to create the database. And hospitals were not willing to do it. They didn't have the resources to spend the money to put in software across the board. And so Cerner did fine in that environment, actually. But what happened was the government stepped in, and the government gave both a stick and a carrot to hospitals to implement this IT software. And basically it's a platform that all this information can flow into. And so every hospital has to make these certain grades on their technology to get money to pay for it, and if they don't, they get penalized. And so Cerner's, you can imagine Cerner's numbers took off like a rocket ship. And so I was concerned that, oh my God, the government is stimulating this thing and has taken 20 years of growth and compacting it into 5. And so I got scared, and we shaved a pretty good piece off at that point. But we didn't sell it completely.
Well, I guess that comes back to one of my earlier questions of what was your maximum amount that you had in any one stock in the fund. You have a stock that turns out to be wildly successful. And then in order to maintain some sort of balance so you're not too dependent on that
Yeah,
one
the
stock.
problem, the fund is a little different because, we're not going to buy Cerner to the same degree as we own it in an account that's been around for 15 years. Because I'm not going to pay the premium, to put 8% of the account into Cerner. So the mix in new accounts is different than existing accounts because of that. The one we're loading up on is the one that hasn't moved, which is level 3.
I
So
understand.
over time, those things will sort of, start to even out between the fund and the individual accounts, but right now, that's why Cerner is not a big a percentage of the fund as it is in your individual accounts.
I guess my point was, if you have a wildly successful company, at some point you need to begin selling some. So
Yeah, it gets up above, you'll see that when a stock gets above 8% of the account, then there better be a darn good reason for us not to start shaving a little bit off. And it gets, the further up beyond 8% it gets, the more we're apt to shave it off. You know, and the reason better be more and more compelling. And so the thing with Cerner was, as it turns out, that, you know, everyone says, oh, everything the government does creates some problems later, or if they stimulate an industry, it's just going to go down later. It's not what's happening this time around. They stoked the fire. This needed to be done. They couldn't do it on their own. The hospitals couldn't do it on their own. But the benefits to us to have this platform is enormous. It might, there's great claims that this technology will reduce the cost of healthcare. I'm not counting on that. It may or it may not. But the huge benefit is you start getting all this information, all this data, that you can start rummaging through this information to find out things about our health on a massive scale. It's going to be a huge benefit to our health. And it wouldn't have gotten done without the government stoking it. And now everyone's recognizing that it's not just the platform is there. Oh my God, what can we do with all this data? And the spending looks like it's just going to actually start to accelerate now. I didn't know that. I was worried that there might be a cliff when the government mandates, you know, started to wear down. And it looks like they have literally stoked the fire. And there's only 2 players left. And the next generation is all about managing all this data. And Cerner has already completely looked beyond what it takes to run it friendly and effectively in the hospital. That's what their competitor is focused on. And if you ask a lot of people, they'll tell you that Epic software is more user-friendly and probably has a better grade from the employees that use it at this point in time. But Cerner's already looked beyond that and said, okay, now we got the platform. They are looking to what to do with all this data when it starts to accumulate in their systems. And so they think that possibly there's 2 competitors now. There'll probably do 2 or 3 competitors later, but it may not be Epic as strong as it is today when we get to the next generation. That's Cerner's claim anyways. But regardless of that, there's still only 2 players. And this is an industry that really does have some legs. David, you want to add anything to this? You've worked on some of it.
Out of all that, I gather you think there's room for Cerner to continue to.
Yeah, the price gets us a little nervous once in a while. So you know, you see we don't buy it very often. We may shave it back a little bit, but yeah, I think that it's got the cycle of what to do with this data. You know, you've heard a lot about big data. This is big data in healthcare, and there's only 2 companies that are accumulating this big data in healthcare. It'd be enormous.
Most of the doctors I go to would agree that it's pain.
Pain. Royal pain in the butt.
But they're getting quite good at it.
But they're going, kicking and screaming. And without it, it wouldn't have without the government prodding them, it wouldn't have happened, and our healthcare system would be, you know, years behind where it's going to be.
Change the subject a little bit. You mentioned computers talking to computers. I understand there's major computer centers being built closer and closer to the stock exchanges. that their sole purpose is to make trades in microseconds to skim off a penny at a time and make billions of dollars. Do you see this as any threat to the general market?
That's a really good question. Warren Buffett calls it front running, which is illegal. That you get, somebody gets information, they jump up ahead of everybody. You're not supposed to do that. And so this is a pretty technical form of front running, and it adds literally no value to society. Actually, it's quite the opposite. And there's really no reason why these folks should be making the kind of money that they're making on something that provides a negative value to society. That's one answer to your question. However, from my perspective, the other answer is anything that creates activity that is not focused on the quality of the company and the valuation of the stock is eventually going to create an opportunity for us. That machine is going to do something really stupid at some point in time. That's going to create a price that's way out of whack to where it should be, and we're going to either take advantage of it on the upside or the downside.
Well, you're so slow compared to that computer, how can you do that?
The computer feeds on itself and can feed, it can start a chain reaction on getting a price. It happened to Procter & Gamble during the, what was that called?
Flash crash.
The flash crash. Procter & Gamble went from 48 to 29 in about 10 minutes. Nothing changed with Procter & Gamble. So if that happened to have been Cerner, we would have loaded the boat in that, you can ask David, I don't wait too long. When one of our stocks hits an air pocket, we're right there. We don't mess around because it doesn't happen very often with a lot of our companies that are recognized as being superior. And so when they do hit an air pocket, we don't spend a couple of days deciding what to do. We already know these companies. So I think it doesn't do any good for society. It will benefit us from time to time.
You've talked a lot about the fiber optics and all the rest of what goes with it. I guess one of the things I'm interested in is, one of the things that attracts me to you as an investment counselor is that you do buy some basic industry. Would you like to talk about investments in basic industry?
We buy this.
Yes.
And if it happens to be in a basic industry, we're okay with that. And if it has to be in some other industry, it takes a little more work and a little more sweat and a little more worry, but we're okay with that too. But this is the secret, for us, is the secret sauce. And, we own Campbell Soup to Cerner. That's really that's a wide range, but they both have things in common. And it's this. They're managed with certain principles.
But you're not scared out of investing in basic industry if it meets that criteria.
I'm not scared out of anything that meets this criteria. We think this is going to work. And to tell you the truth, if I hadn't even heard of fiber optics and all I did with this, my life would have been a lot easier, actually.
I think of your investment in Newport, I think of your investment in Corning, I think of,
Now, these are companies that have these principles in spades.
and, well, this is a step removed because you buy Berkshire Hathaway and they do something with their investment in the railroads. That's investment in the basic industry of America.
They do this stuff in spades.
Yeah, right.
Yeah.
And I think that's important that we don't get wrapped up in the froth.
Don't worry. I mean, that was actually, I breezed through a lot of this, but that was the principal reason, the principal meat of this talk was that we are not going to get caught up in the froth. And there's going to be a bunch of froth.
Sure.
When these markets start to rise, people do stupid stuff. And I'll actually, in a minute, I'll go through some of it. And one thing, you know, I don't know exactly how it's all gonna play out. I do know there's gonna be a lot of dumb stuff that people do, and I also know that we're not gonna get caught up in it. Karen, you have a question?
Oh, I think this guy.
Oh, sorry.
Oh, go ahead.
I was just going to say, I don't see how J.C. Penney fit into that formula.
Oh.
You know I didn't like J.C. Penney, sorry.
Where's
But
my
teamwork,
J.C. Penney?
cooperation, employee empowerment, and they were firing people left and right when they were making these changes. I just don't see how you, I think it was fraud. You got in the fraud that way.
Okay, you ready? Okay, here, as you know, we took an unprofitable foray into J.C. Penney. That's our opening line. Do we have the first? Yeah. I'm going to attempt to give you the reasons why we bought, why I was wrong, and the lessons learned. Is that okay?
That's not. You said, stop there as far as I'm concerned.
So here's why we bought it. Here's what we saw as the positives. The company was an underperformer for a long period of time, which caused the stock to be cheap on a valuation basis. David, you can interject here anytime you'd like. They had a low cost structure. So they owned all their stores that they had bought years and years ago at very low prices, which are carried on the books as. The ones they did not own, they had leases that were carried on the books at very favorable rates. And the locations were terrific locations for a company that didn't perform very well. The brand was very much underutilized, meaning that very few people went there, but it still had a fairly favorable image in most people's minds, in spite of the fact that they never went there. You heard JCPenney and you would get a kind of a warm and fuzzy feeling about it, but you never would go there to shop. Most people didn't shop there. And so the idea is there's a lot of room for improvement. Their business model was to carry somewhat low-end merchandise and then have a series of confusing discounts that they would throw at customers constantly to get the product finally out the door. In spite of this, they were in pretty good financial condition. And then, so it looked like a classic example of a company that could get turned into something better. And so the board brings in this fellow by the name of Ron Johnson. Ron Johnson's resume was that he turned around Target years ago from going the route of a Kmart to bringing in style and design and being a discounter with a little cachet, I guess you would say, which is still kind of their model today. Then he was brought to Apple Computer to create their retail stores from scratch. And he and Steve Jobs worked hand in glove and created the entire retail environment for the Apple products. At that point in time, at the peak of his career at Apple, and at the peak of Apple's success, he leaves to take the job at JCPenney. And according to Ron Johnson, he always had a dream of recreating the department store experience. And the vehicle that he wanted was JCPenney, for the reasons that I just described. So, for me, the connection was when I heard the vision, and we initially heard the vision, stock took off, we go, okay, that was nice. And then they started to run into some problems, and the stock plummeted. And that was sort of how I got sort of lured into evaluating the situation. And so for me, the connection with Ron Johnson was, over the years, we've had two massively successful retail investments. Starbucks and Whole Foods. And Ron Johnson appeared at the time to me to be cut from the same cloth as these two, we think, extraordinary leaders. And so one of the biggest drivers of what Ron Johnson's vision was what Howard Schultz calls the third place. A place that you feel comfortable going to between work and home. So a place where it invites you to come spend time. A comfortable place to hang out. A comfortable place to take your family. And Starbucks has done an enormous job with that. And when I go out of town, if I want to feel like I'm at home, I go to Whole Foods. And I get a little something to eat and I just sit there. It's a delightful place to spend time, and they created these environments. And that was Ron Johnson's primary vision, was to create this kind of an environment. And that was my connection. And I saw the same kind of vision that we've had some enormous success with both Whole Foods and Starbucks. So what he described was to achieve this, and the first thing he did was he widened the aisles in the stores. When you go to a department store, it's just stuffed full of stuff. You can't even get around. The racks are just everywhere. And it's uncomfortable. You want to go in, you want to get what you need, and you want to get out. The first thing he did was clean all that up and widen the aisles. And he called them streets. And in the middle, he was going to put what he called a town square. And in the town square, there would be activities, and the activities would change by the season. And in the streets, his vision was to have seating and kiosks with food and drink, activities for all kids of all ages, I guess, between maybe Legos for the kids and Wi-Fi for something literally for everybody. In a place that would be comfortable to spend time. And then finally, the biggest piece of the vision was to create stores within the store. So that, and initially they had, I think it might have been over 70 brands that they had lined up to come in and create a store within JCPenney stores. So you'd have a Nike store and a Levi store, and the brand would create their own image and the way that they wanted to present their own product. They would kind of own the space within the store to do what they thought would present their goods in the way that thought it presented them in the best light. And that they would treat both the customer and the supplier with respect and as partners. And these are all things that tie into our criteria very tightly. The idea was to get over 100 brands or 100 stores within the store. And then eventually you'd have something for every age group in the family. The kids, the grandpa, everyone would come in and go their own way and find whatever's new with their own brand. It would be a welcoming place that you could almost spend some serious time with your family. So those are all the things that appeal to us. In addition, he talked about treating the shoppers with dignity and creating an experience for them a middle class to lower end shopper that was normally reserved only for high end purchases. So what went wrong? What did I miss? The biggest problem is exactly what you said, Karen. What John Mackey and what Howard Schultz would have done is they would have started with the employees. John Mackey and Howard Schultz would have started with the employees. This guy was not John Mackey and Howard Schultz, emphatically. In fact, he did just the opposite. He did not bring the employees on board first.
I mean, the thing about Whole Foods and Starbucks, even I know that it's, the employees get health insurance, it's a good place to work. That's never been, nor is how the employees feel about JCPenney.
Yeah, we didn't know this going in. We were early enough in the process, we only learned that as time went on. In fact, the biggest problem that the lesson learned, we'll jump to the last sheet. The lesson learned is, you've noticed we've never bought an initial public offering, a new company that's gone public. And the reason is there's no history with these people. You don't have the ability to live with them. And that's the way we should have viewed Ron Johnson coming into JCPenney. We did not have the ability to live with him. There wasn't a public track record when he was at Target or Apple to the degree that we could really get a sense of what his character was. And that was the major mistake and the major lesson learned. And then what happened was that, the other huge issue was he came in and he said, well, this is only for long-term investors. My ears perked up. This is something that's going to take 3 years to make the transition. And so I go, well, also that fits the way we view the world, that we're willing to take a little pain in the short term for something that's going to pay off largely, down the road. Problem is, he took the short-term route. Ron Johnson took the short-term route. This should have been a 5 to 10 year transition, not a 3-year. And what they did was they alienated their customers that were paying the bills, and they never had the cash flow to make the trade. They only had 2 stores out of 100 when they finally, for us, when it was evident that he wasn't going to be able to, build the whole thing out. And then the board pulled the plug on him, and the whole thing was over. A disaster for us. I mean, how often have we actually given up on something? It was a disaster for us. Do you have anything to add to that, David?
I don't. I think it's a great example of, there was a member on the board who promised to give him ample time to do it and was the largest shareholder who pulled the plug on him as well. I mean, it goes back to the other lesson learned, certainly, but I think it's a great example of the reality of how we could struggle with something so intensely for a year and still have a year where things turned out really well in the portfolios. I mean, they were up 20%.
And one thing, we thought we bought the stock at a pretty good price because we kept buying it when the news got bad on big dips. And normally that would mean that on the way out you could take your time and sell it at a better price. We could have got a better price going out, probably. But the whole thing was so distasteful. And JDS Uniphase had dropped significantly because people did not believe that the spending in the telecom sector was going to materialize. They thought they were lying when they initially jumped up and down and said that the spending was coming. And so that stock had dropped fairly precipitously. And so I moved the JCPenney into JDS Uniphase in a couple of days.
Do you sometimes have problems of finding something to sell when you find an excellent prospect? You find something, a JD Uniphase, but you don't have anything right now that you want to sell, and no cash to buy it.
Yeah, it's always a way, and, you know, very, very seldom, actually, that we can't find a little cash someplace. That there isn't something that's gone up that's a little bit bigger percentage of the portfolio. If you notice, that's what we do. Something runs up, we take a little piece off, we throw it into something that's, you know, kind of on the low end.
What sort of portfolio turnover do you have?
Negligible.
How's it, can you put that in percentage?
In
Fund last year was below 10%, and I think the going rate beyond that was 2 or 3% for the first part of this year.
Yeah, I mean, we had years, I mean, I think it was 2010. You know, there's more opportunities, but some years we might not hardly sell anything. This year's, the activity is quite light, other than probably pennies and JDS Uniphase.
Yeah, and if we get cashed out, we're forced to.
Yeah, then there's turnover.
Yeah.
Any other questions?
Is J.C. Penney's the stock to buy now? You got a known manager and the price is way down?
It might be for a Ben Graham type investor, somebody who puts more emphasis on the quantitative value of the stock rather than the qualitative value of the management. And that's a great, Aegis does that. They're experts at it, the Aegis Value Fund that we talked about earlier. We have great admiration for investors that do that. That's just not our model. Our model is to lean towards the qualitative side and be willing to actually pay up a little bit on the quantitative side.
So you don't think the old management was quality then?
Not according to what, no, actually the old model was something that wasn't appealing to me at all in any way, shape, or form. Not to say that at a certain price, they can't make pretty good money. I mean, the stock was $80 at one point with that old model, which is why I said, oh my God, at $20, if they can actually get a model that works on a broader scale, you know, $80 would have been cheap. So that the upside potential was enormous. And somebody is probably going to be able to buy it here, and you know, things are going to get stabilized, and they're going to make reasonable money, and the stock will go back up to 50 or 80, and they'll do quite well. That's not our model. We have to stick to our knitting. All right, we didn't take a break. Seats are probably getting hard. Is there any other questions? Should we? Yeah, I think we'll wrap it up for tonight. Thanks for coming.
Thank you.